NCLT approval, the National Company Law Tribunal approval. So number of changes. Again, this whole sixth theme out here is largely unoperational at this point because of the NCLT still not being set up. But on the whole, if you take a step back and look at all this, I think the intent here seems to be to get corporate India to raise their bar on governance, and that's the broad intent of the legislation. So with that, I'll go through some of the key changes within each of these themes. Again, we can do this two ways. One is either try and make this a little more interactive, so if you have questions, feel free to interrupt, but otherwise you can park your questions towards the end, and anyways I intend to keep about half an hour at the end for Q&A, so if there's something very urgent that you want to raise, please feel free to raise the question. So coming to the change in reporting framework, again, a lot of the changes that have been brought in to look at companies and their financial reporting and financial reporting requirements are largely to bring in a few international concepts. So in that sense, benchmarking the Indian requirements with global best practices. Part of it is to as kind of anti-abuse provisions. Again, I think bringing in more transparency into how companies report their financial information, as well as to plug some holes that they believed were there. So going through some of the changes. So one is the requirement now for companies to present consolidated financial information. So that's like one of the most fundamental changes that has been brought in. So far, you asked, other than listed companies, no other company actually presented consolidated financial information, and even listed companies, only last few years that they've been doing this. But every company which is unlisted, if you ask for financial statements, all that you got was a set of standalone financials, and probably that didn't reflect anything close to what the economic realities were there underlying that when you look at it from an economic entity perspective. From a legal entity, yes, that financial statements would have reflected what it is, but from an economic entity, when you look at all the controlled subsidiaries, associates, joint ventures, and all of that, there's very little reflected in those financial statements. So that way it's one moving towards an internationally accepted practice of companies reporting financial information on a consolidated basis. And second is also that when you're now going to borrow funds and so on, or access any kind of public capital, not necessarily from the equity capital markets, but any kind of public funding, so even from public financial institutions or banks, you now need to start showing your consolidated financial statements as against borrowing on the strength of your standalone financial statements. So it in some cases, yes, it will boost the strength. In some cases, it will actually probably show a much more depleted position as compared to what's there on the standalone financials. So that way, it's a good move that's there. The second change is they've changed the definition of what a subsidiary is and what an associate is, and this was again done to, like I said, plug some of the holes that they found when they were dealing with, let's say, the telecom scam. Because in the telecom scam, they found a lot of front entities that were there which were very thinly capitalized. The owner of equity share capital probably contributed very little, but a large part of the funding was coming through preference capital, and who were practically the people who ultimately had the economic risk as far as that entity was concerned. So they try to find a simple way to plug this. They said when you look at a definition of a subsidiary, you look at who controls the total share capital, which is not just equity share capital, but you also add the preference share capital. Now that was what they thought was a simple way to plug a gap out there, but what it did in reality was kind of distorted reality to a great extent, because a lot of providers of preference capital, including private equity funds, etc., a lot of times they make investments through preference capital, and they are not necessarily the ultimate owners of the company, and they don't probably want to be owners of the company either. So they're there as a financial investor to get a financial return and get out of the company. So it's more debt-like as compared to equity-like, and so it resulted in a lot of situations where I think the whole definition of what is a subsidiary was not reflecting true reality. So when they finally finalized the rules in March, at least they made one change to it. They said, okay, don't look at total share capital, you look at equity share capital plus any convertible preference capital. And so anybody who controls more than 50% of the equity plus convertible preference capital. That is what you determine as being the holding company or the parent company. So to some extent, I think it is now more reflective of what substance is, because at least you're looking at the owners of capital that will ultimately get converted into equity capital. But still there are practical challenges, because there could be optionally convertible preference shares, which also now get classified along with this in the when you look at total share capital and who controls that 50% extra. So it's still not going to reflect substance in a lot of situations, but at least closer to substance than what the original absurd definition would have led us to think. The third is looking at the directors and the independent directors and the audit committee, all of them are now required to comment on the company's internal financial controls. Now, at first glance, this looks like very familiar territory. We think that, okay, all listed companies always had internal controls, so what is new? Or that the auditor's report always had one paragraph on in the Caro report talking of internal controls and all that. So what's new out here? What's new is actually the definition of what is internal financial control. So while the old clause 49, when it spoke of internal controls, it spoke of controls with respect to financial reporting. So very similar to what you have in the US for listed companies, what's called the SOX 404, the Sarbanes-Oxley section 404, which requires companies to comment on their internal controls over financial reporting. So the SEBI requirement is something similar to that, although in practice, I don't think it is followed in similar spirit. But what's now happened with the Companies Act is they've gone and put in a definition there which is very, very wide in scope. So if you go to the definition of what is internal financial control, it talks of policies and procedures followed by the company to ensure an orderly and efficient conduct of business. So you're looking at orderly and efficient conduct of business, which means you're not talking of financial reporting. You're looking at the way you conduct your business and how do you ensure that it is being done in an orderly manner and in an efficient manner. So you're then starting to look at operational areas, operational risks, operational controls, and not just financial reporting. And so initially I thought this is more of a drafting error. I don't think the intention could have been to get companies to go start documenting how they do business rather than actually do business. And so when I picked it up with the ministry, and so they said, no, it was a very conscious move on our part to make this internal control requirement so very wide, because we believe financial reporting is anyways taken care of with all the checks and balances that are there for auditors and so on and so forth. But this was one area where we felt that companies need to feel responsible to the investor community, that they need to be handling investors' assets, investors' funds in the best and the most efficient manner. And therefore, we felt that this is important that they actually start putting in place a detailed control framework around that. And that's how it's now starting to take shape. So the Institute of Chartered Accountants is now working on a guidance note to guide auditors on how they do the evaluation of the internal financial controls. And they're actually referring to a framework called as the COSO 2013 framework, which is internationally one of the most accepted frameworks on internal controls, which looks at financial reporting risks, it looks at operational risk, and it looks at compliance risk. So it's a combination of all of these that's looked at. So therefore, even for a company, let's say in India, which is listed in the US market, follows SOX 404, etc., this will still be a massive exercise for them to now start putting in place policies, procedures, documentation around all aspects of their business, including the operational aspects, including operations. Start documenting what are the key controls within all of that, putting in place a framework to test those controls on a periodic basis and so on. And the reason why all of this documentation becomes extremely important is that so before this started, we were actually just having a chat about responsibilities of directors, responsibilities of independent directors, etc. So the independent directors, so there's now a code of professional conduct for independent directors. And one of the items listed in that code as part of their duties is to say that they are satisfied that the company has a robust and defensible internal control system. So for an independent director who probably spends maybe 2-3 days a quarter in a company, for him to get comfortable that the company has robust and defensible, for him to satisfy himself that the company has got robust and defensible internal financial control system, he will obviously expect to see a lot of documentation and documentation trail. Similarly, when an auditor is required to sign off on this, or a director in the director's responsibility statement is required to sign off on this, I think they will all think twice before stating that yes, the company has this, because any misleading statement that they make, including making a loose statement saying that yes, I'm satisfied that these controls are there, when you actually don't have evidence of those controls being in place, could actually take you to court. You could have a class action suit against you, you could have other investors suing you, and so on and so forth. So there's a significant amount of risks and liabilities that practically hang over each and every stakeholder's head. So be it the independent director, be it the directors, be it auditors. So because of the environment and the changed environment in which each of these people are going to operate, they are going to expect to see a lot more of documentation coming through. So companies will have to spend significant amount of time and effort. So when US companies, for instance, started implementing Sarbanes-Oxley Section 404, they actually spent millions of dollars, and some of the larger companies actually into hundreds of millions of dollars in actually putting together this whole framework on a global basis. So while Indian companies may not need to spend hundreds of millions of dollars, but they will certainly need to spend millions of dollars actually going through some of this documentation, and this is something that will have to become business as usual as they go on. So it's not like a one-time exercise. This is something that's going to change a way a lot of business is getting done. One of the last items on the slide that I had was on the concept of depreciation. Now, hitherto, while this is of course a non-cash item, but this is an item that ultimately impacts EPS, reported earnings of companies, etc. And historically, a lot of Indian companies have followed the Schedule 14 rates. I'm sure most of you are familiar with what is Schedule 14. So that is one of the schedules to the 1956 Act, which laid down the minimum rates for depreciation of assets. And a lot of companies, without actually looking at the useful life of companies, I think just followed those schedule rates. And if you look back at that schedule, yeah, in a lot of cases, that's not reflective of reality. In some cases, the lives are too short. In some cases, the lives are too long. So for instance, for a cement plant, you would have depreciated it at 20 years, whereas the life probably is of 40 years. Whereas on furniture fixtures, while it's probably last 5 years, you would have still depreciated at 15 years or so. So that schedule was certainly not reflective of the useful life. So there's a new schedule that's replaced that called Schedule 2. But while this schedule has come, I think it only is providing indicative useful lives of various assets. It still puts the onus back on companies to say that you demonstrate what is the useful life of assets and depreciate your assets according to that. So we are actually, as I'm dealing with a lot of companies, we are seeing companies actually make this an opportunity to start doing or making their depreciation in line with what they think is the economic useful life of these assets, etc. So you will actually see a change in the pattern of depreciation between companies. Now, this also brings in another angle that, again, I was the board of one of the large airlines the other day, and they were raising a question saying that how do we now bring in comparability into the airline industry, for instance? They said we will want to depreciate maybe this engines over a 20-year life or 15-year life, and maybe this aircraft over a 20-year life, whereas somebody else will probably take a life of 30 years or 35 years. So how do you bring in comparability? And I think that's going to be a big question when you at least start evaluating financial performance, or comparing EPS, reported earnings of companies. So you'll have to start reading that along with a lot of the disclosures that accompany these financial statements to see, okay, if you put them on a comparable basis, how would these look? And so that's where you don't just look at the main number on the financials, but also look at all the accompanying disclosures that come along with this. And the Act actually requires companies to put out detailed justifications for using a life different from what is indicated in the schedule. Now, coming to the second theme on the auditor's accountability. So, if you look at Indian companies, including listed companies or other companies, especially if you look at the promoter-run companies and so on, actually not just promoter, even if you look at MNC companies for that matter, most of them would have had their auditors for a very, very long period of time. So that's been the way companies have kind of operated. So right from the time they set up, I think you would have probably had the same auditors serving them as they grew into companies of $1 billion and probably more. And there was this perception that a long tenure of association between the auditor and the management or the promoters of the company would have kind of impaired the objectivity and the independence of the auditor, and therefore there was a need to break that long-term association. So with that intent to kind of bring in better standards of independence, or at least to deal with that perceived lack of independence issue, they have now brought in this concept of mandatory rotation of auditors. So auditors now need to change every 10 years. So that's the 10 years is the maximum time that an auditor can serve as auditor of a company. And this requirement kind of applies on a retrospective basis. So the ministry is given a 3-year period within which companies need to now comply with this. So those who have had their auditors for 7 or more years will effectively within these 3 years need to now kind of change their auditors. So over the next 3 years,